All right. Thank you guys for joining our quarterly semiconductor update call. My name is Nick Frassi. I am a product manager for our thematic ETF suite, including SMH and SMHX. And I'm joined today by Angus Shillington. He is our global semiconductor analyst. So we want to start briefly today by just revisiting where we've been, right? Let me see if I can get the slides to go. There you go. Revisiting where we've been, what's played out since our last call, how our framework has held up, and then we'll touch on NVIDIA's earnings from yesterday, and then what that means for the broader context of AI and semiconductors. And then after that, we just want to open it up to Q&A, right? Since that's where we get the most value, and I think our clients from feedback have said that's where they get the most value. We want to turn to that. So let's unpack that together, right? So first, let's start with a scorecard of where we've been and what we've called so far. So first and foremost, CapEx spend from hyperscalers. Angus requested that I give us a grade here, like we're in elementary school again, which is fine. So the CapEx spend from hyperscalers, we gave ourselves, say, an A-. Spending, I think, was too conservative, and they have said that. A lot of the Satya from Microsoft saying that was the biggest risk was underspending. So Microsoft, Meta, the hyperscalers continue to push those numbers higher, and it shows this isn't a one-year build-out, right? It's a long-term infrastructure cycle. Then looking at the broader opportunity for multiple names in the space to be successful, I would say we gave ourselves a B in that regard. We always said this wasn't a one company story. Obviously, NVIDIA has grabbed a lot of the headlines, and that's true. The whole semiconductor stack is benefiting, right? From manufacturing to design, but we underestimated maybe how far down the stack that was actually going to go and how far the opportunity would run. So companies in power, packaging, networking, all of these have become key players within the AI chain. Fabless optimizers for the next thing that we talked about, right? I would say we gave ourselves an A+ for this. We were pretty nail on the head as far as launching SMHX, our fabless semiconductor ETF. That's been a defining constraint within the AI build-out. Power access, grid capacity are major investment factors, and the fabless names are the ones that are solving for these bottlenecks. So I would say that we were pretty much on the mark there. Then looking at demand versus supply and the leading edge, I would say we gave ourselves a B for that. We were right that the supply was not going to be able to keep up with the demand, but the scale of that, I think, has surprised everybody. So I would say we didn't give ourselves an A in that regard, just because we, like a lot of other people's, even though we were knew that the scale needed to be there, maybe the size of it was definitely overwhelming. And then I would say how things that we maybe mistimed, I wouldn't say we got wrong, but mistimed, right? And I think that's the key here is like the scale at with which this is happening and the speed with which this is happening. Model specialization, custom silicon, all of that came very quickly. Each new generation of AI chips has been bigger, more complex than anybody really modeled. And I think that is filling the gap of Moore's Law as we get into, nanometer sizes. It's hard to double the number of transistors on a wafer at that level. So, the software and the actual GPUs themselves needed to get better, and that's what we've seen from just the H100 to the Blackwell, right? And then the demand for compute, right? Especially token throughput, which I think we're going to touch on today to define tokens for those who aren't aware or just don't understand the concept of it, has really outpaced even the most optimistic forecast, right? So it seems like everybody is too conservative with the speed with which this is happening, right? So I think that's really the theme. And it's clear is that the direction has been correct, but the speed with which it's happening, and maybe that's we'll get into the question of a bubble, et cetera, but maybe that's what is leading to a lot of these questions, right? So I'll turn it over now to Angus. It'll be your time to shine. Having looked at all of that, where we've been, the calls that we've made, graded ourselves, right? I think we're probably solely in a B+ category as far as that's concerned, of 2 years of these calls. How much, I guess, has your thesis changed on the space and your mind map shifted?
Sure. Thanks, Nick. Hi, everyone. Thanks for dialing in. I'm going to have to sort of push back a bit on the B+. Maybe an A-. Look, we've sort of nailed it. We've nailed the direction. We've kept people we've kept ourselves in the trade and hopefully helped you guys stay in. So let's keep this super focused, right? Drive everything into Q&A. We are analysts for semiconductors. Let's make that really clear. So we will talk a little about customers, but this is a semis call, right? So here are my three conclusions right up front. Number one, right? How I'm invested right now in the active funds I managed, very heavily invested, right? With the thesis that says the risk to share prices right now is materially skewed to the upside. So very clear. I believe the risk is materially skewed to the upside, not to the downside. This is a long held thesis, meaning I had it before yesterday's numbers. It's a 2-year time horizon. I believed it 2 years ago, believed it in the last 3 weeks, and I believed it very strongly after the NVIDIA numbers. So that's point one. Point two, the upside risk applies up and down the semi stack. So that's from the apex predators of NVIDIA and Broadcom through fabs, TSMC, all the way down through semi-cap equipment, ASML, and into hardened software suppliers as well. So it's remained very positive. I think one of the benefits of grading ourselves is not to say we were right, is to validate that we have a thesis that works. But importantly, I want to say, like, we always want to think we've made a mistake. So we listen to the bearish, we push our thesis very hard. So that's point two. And then I think AI more broadly. Look, there are pockets of excess. There's no doubt about that. There are some execution issues, mainly around electricity, power. Debt is rising. We flagged that before it happened. And it's nothing surprising or frightening to us. And maybe OpenAI is creating a bubble-like situation. That risk won't be known for a while. And they could even stick the landing. So I don't think that's really an issue. So in the semi space, demand vastly exceeds supply, right? CapEx, we're going to validate. Demand is quasi-monopolies. That's a big deal. And I would say we're in the watch out phase, not the get out phase. And watch out does not mean bearish. Watch out means the shares of semis could go up a lot from here. Watch out means that the risks we started talking about 3 to 6 months ago of increasing debt are turning up. At some point the wave will crest, right? At some point. I don't think we're anywhere close to the top of the bubble in semiconductors, or I'm not sure we're even in a bubble in semis right now. So I'm not changing my aggressive positioning in the funds that I manage actively. And if anything, I would be adding, obviously undisclosed, in this dip. So Nick, let's get to the slides.
Yep.
So we're going to talk first about token demand, because demand is what's driving this. It's pulling this. But Nick mentioned to me yesterday, I think it was a great point, that perhaps people don't know what tokens are. So we asked ChatGPT to build us a slide to tell us what tokens are, right? AI tokens are the fuel for intelligence. So, more users, more queries, more complex tasks, longer prompts. And this is really what's driving it. The more people that get on to large language models, each query takes tokens, each answer takes tokens. So not to come up short for you guys, we then went on and asked the question in the next slide, how many tokens would have been needed to build this slide, i.e. the slide they gave us at the very top with calculations by query. So basically it says it took 60 tokens to read and understand the prompt, and then tokens out were about 120 to build the slides. So together there was 180 tokens. This is a very simple task. And the journey into AI for most people on this call will be the same. You start with a dumb question, you're surprised by the answer, and then it's doing your sort of household accounts, optimizing your portfolio in a fairly short period of time. So this sort of gets us to the chart on the next page, which is demand for AI tokens is exponential. And it shows no sign of slowing down, right? So it's really about focusing on the demand piece. Like, if this was flattening out or maybe even going down, I think you'd have a problem. It is not. It is going exponential. And I think I don't even need to get that much more complicated. 3,800% growth over a 12-month period. and going one way. So let's go to the next one. Is, we believe that this sort of CapEx ROI is actually validated now, right? A big part of the bear thesis is, nobody's going to make any money. Look, we heard it from third quarter from the hyperscalers. New supply is being deployed profitably immediately by Google and Microsoft. And I'm going to be honest, like if you're a shareholder, you shouldn't be upset with what they're spending. You should be upset that they're not actually spending more right now because, as I said, it is deploying immediately. The game is really just to build out, right, as much efficient CapEx as possible. And once you can get token pricing down, really flex that pricing piece. So the ROIC, ROE thing is here. Don't let anybody tell you otherwise. It is coming directly through the hyperscalers. Here's a couple of charts that SemiNAS put up. Azure, which is the cloud, the AI cloud business behind Microsoft, growing 50%, right, sequentially deep into 27. And then specifically to return on invested capital, the blue bars are Oracle, yellow bars are Microsoft. We're broken through 30% return on invested capital. I would ask you to point for AI specific. I'd ask anyone to point to, more than a handful of businesses in the S&P 500 who receive 30% ROI on upfront investment. So I believe it's with us. We're hearing it loud and clear. Google and Meta, very clear profitability upticks on their recommender engines, on their direct advertising systems, but also in the last set of numbers from the S&P 500 period, right? Third quarter numbers from the S&P 500, we have a handful of companies that have started to talk about margin benefits of AI on their businesses. And I think it's really worth noting, like it took 5 years for the S&P companies in aggregate to migrate from from on-premises compute to cloud compute, which was sort of the last big shift in computing modality. So, it makes sense they're going to be behind the curve, but it's here. And I think that's a very clear point. The next thesis point on the next slide is that monopolies are benefiting and driving, right? And it's triggering word, but that's where we believe you should invest in monopolies, right? So we put up TSMC to make a point that TSMC, I think in my thesis, became a monopoly in 2020 when sort of Intel stopped being able to compete. They have defeated all their peer group. They make all the chips that go into pretty much all the data centers at the leading edge, right? So how do you get to be a monopoly? You get to be a monopoly by having the best product, right? So they've knocked out Global Foundries, they've knocked out Intel and every other real competitor. That gives you all the customers. And if you've got all the customers, you have all the cash flow. And if you have all the cash flow, you can extend your moat by investing further and further at the edge. So I think about this as gross margin, which is this slide, tells you how much competition there is with TSMC. And you can see it just sharply went up coming out of the pandemic. Now that was there was a bit of a spike there, but we're back at those levels and they're guiding to over 60% later this year. So this is a stack of monopolies all the way down. So that's a very strong thesis point. You need to stay with the winners. And then I think just sort of touching on the valuation piece, we've got a slide on, next slide now. Okay, orange line is the PE ratio of NVIDIA back to 2022. The blue bars is the NVIDIA share price. The thing that's wrong with this chart is the share price is going up, but the multiple's coming down. And that effectively tells you that earnings are driving this company, right? So earnings are driving this company, which is sort of super interesting. I'm going to now touch on the NVIDIA earnings, because when you use a PE, right, you've got to understand that the earnings is dynamic, and NVIDIA's earnings only are upgraded. Now, that will end at some point in time, but it is not ending right now. So the NVIDIA numbers, maybe they could just take that down. Huge beat. Sharp and immediate upgrades to analyst consensus. I looked this morning when I got up, so it wasn't that long. Next year's sensible analysts are around $8 a share. I'll tell you what that means in a second. And have gone to over $10 a share 24 months out. Now, what does that mean? That means we're looking at 60% growth year on year, 12 months out. And we're looking at EPS doubling over 24 months, right? For a company that has a market cap of $4.5 trillion, that's quite a feat. So does that deserve a 25 multiple, 30 multiple? I'm not sure. I don't think so. So I believe we're going to continue to get these growth numbers. So we're going to price into 24 month out EPS, which is, as I say, double probably where we end up this year. And that should come through in pretty satisfying share price. What else did we hear from NVIDIA? Some pretty sort of crazy sellout type numbers. They can't make enough, right? And that's really sort of another big point of thesis I have up and down the supply chain is like capacity is immensely tight, right? We've heard from the makers of memory, we've heard from TSMC, they can't make any more, right? So if they can't make any more, the demand exceeds supply at the top of the food chain. So think about that as Broadcom and NVIDIA. Prices are going to go up, and the laws of economics will kick in. So although we're getting a sort of demand build on earnings upgrades for NVIDIA and Broadcom, I believe there's a price build to come too, which has a lot of operating leverage through businesses with a 70 gross margin or a whatever it is, 40 or 50 operating margin. So I still see some significant upside. I think that the multiples are probably too low. At 60% growth year on year, a below 30 multiple doesn't seem right, especially when it went to a 55 multiple 2 years ago based on those kind of growth numbers. So let's sort of leave that there. The one other piece that was interesting is that NVIDIA pointed to cost of goods sold creeping up. Cost of goods sold is effectively what they pay to TSMC, very simply. So we're finally getting something we talked about a year ago, which is TSMC are being allowed to raise their prices, right? My sort of takeaway from that is because TSMC, given that they don't have a lot of competition, and since every new fab is several $billions, right? Tens of billions of dollars. They don't want to build new capacity yet. All their customers, NVIDIA, OpenAI, want them to build new capacity. So I think prices are being allowed to drift up in order to get TSMC to add to their capex. I think by the end of this year, we'll see that go up 10 to 15%. And again, that feeds down into ASML, that cascades into Synopsys. So back to the point that supply demand is out of balance, which means when you run that through capacity constraints, you'll probably get pricing power, and that cascades the whole way down. So like, I'm not here to promote SMH, but the way to sort of think about the opportunities, just go look at the holdings there, because it sort of broadly represents what I'm talking about in terms of these sort of monopoly drivers. The one other point, and then I'm going to shut up and pass it back to Nick for questions. They addressed some of the speculative concerns, and we'll get to some of that in Q&A. But the thing that I found was just so overwhelming was the partnership proposition that they always talk about. But partnership extends to co-design, like making sure you have the right server to put in your data center, making sure you have support, making sure you have the software top piece, making sure you have the AI code libraries to drop into it, and making sure that you also have access to capital. Let me leave it there, because I think we've covered a lot. But I think, as I said up front, I think the risk to share prices in this ecosystem is very heavily skewed to the upside right now, and that's my view. I don't expect you to. I don't really want you to invest around it, but I do expect you to at least acknowledge it, given the track record we've had.
Sure, that's exactly what we were looking for, I think. And maybe to put a bow on it too, to tie it back to the beginning when we talked about tokens and token demand, right? So you lay out this thesis for the supply demand imbalance. but I think it's important to look at it from a holistic view, 2 years out, 3 years out, and say token demand isn't slowing. We're at the early stages of adoption here, right? It's a search query alternative for a lot of people. We haven't seen the implementation deep into many layers of business at a commercial level, and then from an integration standpoint in our everyday lives, right, outside of it just being this chat bot that we work with that helps us be smarter about whatever it is that we're looking for answers for, right? So I think it's important to put all of those things in the context of the token demand and the fact that token demand is not really slowing at any point in time. So it should lead us to the conclusion that supply is going to continue or demand is going to continue to outpace supply, in the foreseeable future.
But I think just to sort of hit on that point I made before, there are large blobs of token demand that haven't yet been
yeah
like brought into the picture, and I think S&P 500, enterprise sovereign, that stuff's coming in, and it's just a reality. So you must make your data centers more efficient, right? If you're a provider of tokens, therefore cheaper, that's demand. But also there is demand vertically coming through, just straight up new customers, new tasks, new projects, new workloads.
Yep. And I think that ties us. So I tried to shift or put these questions together in a format that I thought made sense that we've gotten in. So first and foremost, I guess the elephant in the room from a question perspective is the bubble talk, right? Is AI a bubble? We put it on the screen, right, to get people in here to talk about it. But I guess the fact that it is being talked about as a bubble, what do you think is the difference between a bubble maybe that destroys value and one maybe that is going to build future growth? And is this a structural bubble? Is there any parallels to other bubbles that we've seen, and how are you viewing that?
I'm going to make the assumption half the questions that have come in so far have been in bubbles. So let's just be really clear on this. So I don't hate bubbles. There are some really strong benefits of bubbles, right? They create, the site of enthusiasm and optimism, which creates sort of self-fulfilling innovative outcomes. So if you bring all the capital and all the people, so if you go to Silicon Valley right now and you walk around every single office, every single cubicle, and ask everybody what they're doing, literally every single person is working on AI. So that's a lot of trial and error. That's a lot of idea gen. So not it's the site of coordination for people and capital is sort of what a bubble creates, right? So, but I think also you want to think about, inflection bubbles versus sort of mean reverting bubbles. So inflection bubble is something that is order the magnitude better, right? So let's say, the change from a Motorola phone to an iPhone. I mean, I don't even know you can put a number on that, but that is like thousands of percent better. That's what AI is. And then you think about like a mean reverting bubble, like real estate prices in 2005 to 2008 went up 70%, and that blew up that bubble, and it mean reverted. So, mean reversion bubbles are percentages. Innovation inflection bubbles are orders of magnitude. So you think about it also in that context. Bubbles are necessary to lay infrastructure, the demand phase, and bring on this collective sort of action. So there are some, tangible benefits. Do I think we are in a bubble? I think there are bubble places. There's points of bubbly behavior. I talk about, the center of it has to be this sort of open AI, over $1 trillion of sort of committed capex that is effectively unfunded. I think they'll probably stick the landing, but that's sort of the only one I can sort of pull in myself. So. And I think it's worth making the point that Satya Nadella made in on the Microsoft call. Is like, if you build a data center for OpenAI and OpenAI don't show up, this stuff is fungible. You can use it for anything. So, it's just trying to right size the view around bubbles, right? Maybe just touch on the value. We had a valuation slide in there as well, and I think it's probably worth bringing up.
Hold on, let me show. 1 second.
This new technology fell in the laps of the best funded, highest growth, highest quality businesses currently in the world, right? So it's going to feel big, and the share prices are going to look like they're going to go up a lot. But when you framework, here we are. So left side is top tech names in the 90s, right? So we're sort of in the sort of 70 to 100 range. And then the top 7 tech names today, and arguably Nvidia's gone down 5% today, even though the share price has gone up because earnings have gone up. Just think about it that way. Like, these companies are growing, they're validating the reason for the growth that I try to lay out in the thesis, and the multiples are still at levels that I wouldn't even get out of bed to call bubbles. So let's sort of leave that there. Does that make sense?
No, that's perfect. And I think maybe just to regurgitate every single podcast that's been posted in the last, 6 months would be, if you look at the parallels, which everyone likes to draw, of the internet to today, right? Because it's a technological aspect, right? This is probably more akin to the personal computer than it is the internet. But what burst the bubble in the internet was the telecom, right? And there was over infrastructure spending on what they were calling dark fiber. These data centers are anything but dark. They get lit up like a Christmas tree as soon as they get turned on. The exact opposite is the problem, right? So I think that's important to keep in mind from a framework perspective. And then also, like, I'm sure people are sick of hearing me say this, but the Sir John Templeton quote about bull markets being born in pessimism, grow in skepticism, peak in optimism, and die in euphoria. When everyone is saying a bubble, it doesn't really feel like euphoria, right? Or if you put that in the context of, say, 2017, when you're at Christmas and everyone's talking to your aunt who doesn't know anything about finances buying Bitcoin, that sounds a little bubbly, right? Like, or that sounds a little frothy when you start to get in that realm. But the amount of people talking about it would lead us to believe that maybe, we're not in euphoria by any means. So in that same, we'll move on, but in that same bubbly behavior conversation, we had a question on the circular financing aspect that's going on, right? And that being something that people were pointing to as what could be that bubbly behavior, if you will. So maybe outline, what your perspective on that is.
I mean, let's really simplify the question. I mean, it's a bit.
Yes.
This is basically Nvidia investing in its customers, right? And in some cases providing working capital. So let's look at it through that lens. We have massive monster private startups, OpenAI, Anthropic, that have, for all intents and purposes, outgrown VC, right? So the scale of capital they want is just too much for the VC industry. I would argue that Nvidia is behaving like a VC, right? And given its sort of adjacency and visibility into these businesses, I would argue they've got the best risk process of anybody than any VC, right? So let's put it, they are acting like a VC. They are providing capital. These businesses are not ready for an IPO and they need capital. It makes complete sense. And then I think you flip it to what we just saw in the last couple of weeks. Look, debt markets choked around not a lot of new debt. It was mostly around sort of narrative and some risk off in the sort of global risk complex. But if I was a builder of data centers, I would take liquidity from Nvidia way before I go to the debt market and have that thing happen, 2 or 3 times a year. So I think, what Nvidia is doing, and I sort of loops back into my partnership pieces, they are acting like VCs and partners, right? And a VC and partner is a very similar thing, which is they're providing liquidity, they're taking stock for that liquidity, which a VC would do, and they're investing in the best in class product and services that they can find, right? And Nvidia as a partnership proposition to customers, right, is the best in class product, right? And it's providing additional services. I think about what we're doing now. Like, FanEck tries to build best in class product. And what you and I, Nick, are trying to do right now is provide additional services by sharing our thesis, right? Like, there's nothing unreasonable about that. And like, from a basic business perspective, Nvidia wants as many customers to be on their CUDA platform, software platform, because once you're on that, it's difficult to get off. This just extends the reach of CUDA. So ultimately, and I think in both cases, like, I don't think there's a real issue. And I think it's about how you frame it and how you think about it.
Yeah. I think that's a good way to look. And when we were talking about it yesterday, and just recapping for the call, when we talked about the VC aspect of it and the fact that these companies OpenAI is just can't be funded by VC anymore. So why wouldn't you partner with the same people that you were going to use the VC money for anyways, right? if they're not ready to IPO yet for that aspect. And I think that was really like the way you explained it was perfect to me. I mean, I
Well,
think it made a lot of
look.
sense.
I mean, if OpenAI can't get capital, they can't buy NVIDIA chips. Like, I mean, this isn't. I mean, it's just thinking about the incentives and risk, right? It's the incentives and the risk both favor NVIDIA to partner with OpenAI in order to, unlock their potential.
Yeah, and I think if it were happening more across more names within the AI space, maybe that could be more problematic. But it doesn't lead me to believe that either. So that makes perfect sense to me. So moving on, I guess maybe the next thing that we've continued to hear, or what may be one of the bigger questions out there, is the power bottleneck. Or I guess more important questions. I wouldn't say bigger, but more important questions is the power bottleneck, right? It is clear that that's becoming one of the biggest constraints for AI expansion. Are we underestimating how fast that can change? Obviously there are economic incentives, there's regulatory aspects to it. There are new energy projects coming online, but I guess, is this a short-term bottleneck? Is this a multi-year challenge? What's the framework for thinking about that?
Look, I mean, again, it is all about framing. If you approach this from a negative perspective, right, and you want to put a negative spin on it, you'll say it kills it, right? Which doesn't take any account for where we will be with power at a point of time when that power increase is needed. So let's just throw that to one side. The logical approach, I think, is to think about power as a governor of data center build out, right? So if you're fearful of just rampant, crazy data centers everywhere, buying houses in Chicago and filling them with GPUs, if there isn't enough power, that's not going to happen, right? So think about it as a governor of risk on that. So that would be point number one. Point number two, the positives extend beyond that, right? Because, for example, Blackwell, the new NVIDIA chip is 34 times more power efficient than the previous. So that gives pricing power to NVIDIA, right? People want to buy more, and that's part of our thesis. But it also, think about sort of the other bottleneck and why we built SMHX is like fabless designers generally provide optimization silicon, right? Across the scale out phase. That's how I sort of broadly think about it, though, data management, power management, that kind of stuff. So it unlocks that as well. So if I sort of think about the risks to power, where I end up is like more efficient chips, more efficient chips, less undisciplined capex. But I think the bigger the power constraint gets, the more likely it is to get a sort of broader, like systematic government-led unlock. And and these domain adjacencies play into each other, right? So if you get power supply up and power prices down, there'll be a bunch of technologies that we don't even think about that haven't even been approached because the mathematics, when you pencil them out on the price of power right now, doesn't work. Take power down by 80%. Some really interesting innovation will turn up. So I don't, I think about it as a limiter. I think about it as a risk controller. I don't think about it as a sort of bubble popper.
Yeah, I think and I think I've actually said this before, but I think a lot of times as human beings, we're looking for one solution, right? Well, we need power. So what's going to be the power that's going to fuel all these data centers? But it's a lot of things coalescing together at the same time, right? It's the efficiencies of the chip. It's, finding new power. It's pulling down regulatory aspects to create more incentive. It's a lot of these things converging together to get to the number that makes sense for everybody to
Exactly.
continue to drive growth, right? It's not one solution is going to fix all of it. So I think it's important. And I think, similar to kind of how China approaches things, I think maybe innovation will come at the forefront first because we're so constrained by power, right? And they need more now, that you're going to see more of these fabless companies and more of these bottleneck providers be able to solve some of those issues in the near term to provide more upside and get more efficient chips and more efficient data centers so that they don't need as much power. And then when the power comes on, then you can build more, right? So they all kind of coalesce together and come together. And it's not going to be one solution to fix all of it.
Look, I mean, what have semiconductors done since the dawn of time? They've made everything more efficient.
And they get more efficient, right?
So to stand up and say we've got a constraint, an inefficiency constraint, you should bail on semiconductors, like makes absolutely no sense historically or logically or anyways. And I think this is sort of what's been so damaging about this sort of bear thesis, which some of it is legitimate, but super in the fringes, and it shakes people out of positions they shouldn't be shaken out of, and they get radicalized themselves because, like, if you sell Nvidia 200 and then it goes to 300, you become one of those guys on Twitter screaming about how overvalued. So the whole thing just like feeds off of itself.
Yep. It's yes, it's 100% herd mentality. A lot of times, creating a cult of personality on the good side or the bad side for sure. Okay, let's move on. OpenAI. We talked about circular deals. Obviously, a lot of the headlines. The clear network leader from that perspective. Deals and being announced, viewing some of this signs as success. I guess how do you interpret the OpenAI landscape? If you want to hum a few bars on that.
Yeah, so like unfunded $1 trillion of capex is probably the biggest risk out there. So that's sort of point number one. But an awesome product, and it's scaling like crazy, right? They have so many monetization levers. Like, okay, let's say they have. I mean, I think it's 1 billion active weekly users now.
Yeah.
Let's say they take half of those and they ask them to pay $8 more a month, right? And the value transfer is huge, so I'd be surprised if there wasn't the elasticity. That would be like $100 a year. Make half of them pay that. That's $50 billion immediately in increased revenue. And given it took no capex, that's $50 billion of profit. So there's room to do stuff like that. And what they've been doing with these sort of commitment deals has been to diffuse their forward-looking capex risk, right? So, they're not building all this stuff. So, Oracle's building a bunch, and Microsoft are building a bunch. So it's not as big as you think it is. I don't want to make a sort of prediction. First of all, you don't need to because the thing's not listed, and most of us don't hold it. Yep. But what I would say, we managed to survive like WorldCom blowing up. We survived, a bunch of Netscape type of stuff. We'll survive if it happens, because if it happens, it won't be it spends $1 trillion and then it goes bust. At a certain point along the way, it'll be understood that goal is not there and that capex won't be deployed. So I just don't really think of it as a bubble. I just don't. But I think it's front and center in that negative thesis in a way that it should not be.
Gotcha. Okay. Well, let's try to let's hone her in here and land the plane. I had a few rapid fire questions, but then also some ending ones, and I think I can tie a few more that we got here in it. So there's, to your fringe bears, right? I know we talked about the bears. Michael Burry has made headlines, obviously, The Big Short. He's very famous for that. Shorting Nvidia, or selling his Nvidia, or shorter and sell. I honestly caught the headline. Seems like he's in every 6 months calling for something to explode since '08. So I didn't pay as much, but shorting semiconductor stocks, I guess. But we've seen some of that bubble up in the news, et cetera. What's your take on it? Because we've seen some questions in the chat today asking the same kind of thing.
I mean, first of all, you need domain expertise, right? So, when you think about our partnership, we're trying to show up here with, a couple of guys who know this space really pretty damn well. I've been following semiconductors for 27 years. I lived in Asia. Like, this kind of stuff is important to make calls. You can't be an expert on tech if you don't understand tech. And I would just that's my answer.
Got it.
You can make pattern matches to 1999, or you can make pattern matches to railroad. In effect, they don't matter if you don't actually understand what's going on.
Understood. And I find that to be the case a lot of times when you see opinion pieces and stuff. You start to dig into it and read it, and it's pretty clear that either A, they're not using the technology, or they're there for clicks, that they're they're just
Look, I
trying
mean,
to grab it.
but part of my process is assuming I'm wrong, right, or we're
Yeah.
wrong, and
Yeah.
that involves listening to the
Hmm.
other side. And I respect all opinions. I just don't. A lot of it doesn't make much practical sense. It
Sure.
just, I understand what it means, but it doesn't make a lot of sense.
Got it. On a more positive note, but still maybe slightly negative, Peter Thiel, SoftBank trimming NVIDIA stakes, that made some headlines too. I know we talked about it briefly, but maybe just uh, one or two bars on that, I think would be good to touch on.
Peel, I'm not sure. I mean, I heard Brad Gerstner also trimmed his position. I mean, first of all, you've made a lot of money.
Yeah, these are tech
And
bulls too.
these guys will be deploying elsewhere, so it doesn't. But also, like, risk management. It gets to over 10% of your portfolio. Good chance your manager's going to ping you on that.
Sure, that makes
And then
sense.
I think on the SoftBank is definitely redeployment. I mean, they've got big numbers out there to Stargate and some other guys. But when sentiment is on the fence and leaning negative, this stuff gets very noisy. So I
Yep.
think again, this is sort of again what we are trying to do here is like forget that we have good product, but the partnership proposition. I think Nick and I were trying to do just for everyone out there is like you don't need to think we're right. Try to understand what our thesis is so that you can make a better decision around this stuff so your clients don't end up with nothing when something goes up a lot. And that's the push and pull.
Yep, for sure. Yeah, it's try to scratch away the noise and really just keep the long-term perspective in focus, because I think that's what we're here to do, right? Talking about broad diversified ETFs and how they're driving the space forward and how to access it.
Sure.
What about AMD and maybe some of these other individual names that made some headlines early on? We haven't heard too much about them. I guess any thoughts around on that?
Yeah, I mean that's a super common question, and I get it. So first of all, we want to stay away from stock-specific recommendations, right? This is not
Sure.
that.
Yep. Yep.
Our view is always diversify,
Yep.
diversify into quality and diversify up and down the stack. So let's sort of put it that way. So, we called the Intel government thing. I would never buy Intel, but I'm okay holding it through SMH. So that's how I think about it. But like specifically, since we're here, NVIDIA and AMD are completely different league, right? In terms of execution and modes, in terms of growth, multiple resilience, all that kind of stuff. My question is not don't buy. My point is not don't buy AMD. It's like why would you own it over NVIDIA? It just doesn't. It doesn't seem like the right risk to take given the moats, the technology advantages. But also, did you know that Lisa, the CEO of AMD,
I
is
did, yes.
Jensen's cousin? Oh, okay, you did.
Yes.
Okay, all
Yes. Maybe some people might not. I think you've told me that before, though. That is a fun fact. They're going to have a lot to talk about here the holidays for sure. Okay, let's end it here, I guess, with this question, but well, maybe not the last thing we talk about, but I guess, what does wrong look like, and what are our flags? What are our red flags or our beige flags, as the kids would say today? What are we looking for here?
Yeah, I would say, look, here's what I think probably will happen. I think we're going to end up recognizing the growth that's starting to blow out, and it makes total sense. So now that NVIDIA 60, it can't grow at 60 forever, right? So let's say it prices to 1 times peg. I'm just making up numbers. Like say NVIDIA goes to 60 times earnings because it's 60 times growth for percent growth for a couple of years, and it goes back to 25% growth, which for a by then like $30 trillion company is
Pretty
completely
normal. That's
rational.
great. That's still pretty good.
The multiple will crash, right? So
Yeah.
you're looking for a slowdown in incremental demand, and that'll happen sooner or later, and we'll try to communicate that. Or you start to see some negative data around, Microsoft reports a huge miss, everyone signs up for Copilot and then they cancel it, something like that. But again, we're not even close to that. But we'll try and keep up in these calls. You and I are on X. I try really hard to um,
Yep.
keep fresh with inflection. I don't put a ton up there, but if there is a change of view, I will put it up there. So I think that's where we are, and we're very kind of we try to be super humble about how we approach these views. Like if you look a long way out, it's easier to make changes with sort of incoming short-term data than it is if you're just focused on the windshield.
Yep.
Yeah, we're very, very aware of constantly stress testing our thesis and our numbers.
Yep. And I think it goes back to our first call ever doing this is, it, and in our view, it's very difficult to pick individual winners. Obviously, there are, certain companies that have shifted to the top of the stack, but owning the entire stack because they all win together just seems like a more logical way to approach it, especially in such a new technology that is rapidly evolving and we don't know exactly what the 5 or 7 year time horizon looks like, right? Owning a diversified stack of names, with all the leading companies and then all of the companies that are solving for the bottlenecks on the SMHX side, with the fabless designers that are fixing those power problems, all those different bottlenecks that we talked about, it just seems like that, would be the more logical approach. But our goal here is to just provide our clients and the listeners with as much information and try to be as, as logical as possible in the space where there is a lot of noise, obviously, and AI grabs a lot of headlines, so it's easy to grab a microphone and get some attention. We're just trying to really think through it and provide as much thoughtful value as possible. So I'd say that's our biggest takeaway. Cool. All right. Well, thank you all for joining the call. We appreciate it as always. I think they put a poll up on the screen for you guys. If you have any additional questions that we didn't get to, please feel free to reach out to our inbox, or if you're a financial advisor, feel free to reach out to your dedicated team, and we are more than happy to answer those questions. So again, thank you guys very much for the time, and enjoy the holidays, and we'll see you guys next quarter.